Hello, and welcome to Bust and Beyond with your host, Robin Hayhurst. In this podcast, Robin will introduce guests that have known failure and want to share their story about how they got through it and what happened next. This will make you learn how to see things from a new perspective and avoid making the same mistakes. Please welcome Robin Hayhurst.
So we met a while ago, and you kind of said you'd come on and have a chat about really what you've seen from the accountancy side about companies and how they have failed or been near failure and kind of what you've learned from that. So perhaps you'd like to kind of tell me a little bit about, what you do, why you do it, and then we can move on to talk about some of the companies you've worked with.
So, we set an accountancy firm up about 17 years ago. And we do the accounts, bookkeeping and payroll, that sort of stuff for clients. And we have done for many years. Then a few years ago, we sort of stumbled across the book Profit First by Mike. And we thought, this is really clever. This is onto something. We were already telling some of our clients to have separate bank accounts, but not at the level that obviously the book talks about. So, we read it a couple of times. We did it on ourselves, got some results, thought that's really clever and brilliant. So we tested it on a few clients, worked with them. So we reached out to Mike and we learned all about the sort of accreditation process. So we did all the training, we passed all the tests, we've got the accreditation. In fact, we've got a nice little video from him as well, acknowledging us. And we are the only Profit First certified accountancy firm in Wales at the moment, as of today anyway.
Is the reason you didn't say his surname is like me, you can't pronounce it?
Yes.
So just to be clear to everybody listening, it's a book called Profit First. There are various guises of it. There's one that I use for my clients, which is Profit First for Contractors, which is actually written by someone else, but it's based on that book. It's a really simple system to help you run your business and to make sure that you make a profit and to control your finances. And I would say it's a snapshot look at your business, isn't it, that gives you kind of feedback instantly.
It's really clever, yeah. It's sort of, I don't know if we're allowed to say this or not, but we sort of call it like some sort of Google Translate between the actual accounts, that, your accountants, if you like, and the actual bank accounts and everything in between. So you'll hopefully get that snapshot and see what's going on.
That's wonderful. So how many companies have you put this into, and have you had any that have kind of really been near failure when you've gone in and turned it around using the system?
Yeah, good. There's a couple of points. So in terms of businesses that are near failure, we see patterns, if you like, because of course we work with best part of 1,000 clients, all different sizes and different sectors and things like that. Yeah, essentially we see a pattern, and in the main, the ones that tend to find themselves in financial difficulty are the ones that are perhaps either not understanding all their finances correctly in the best way or making the right decisions. And chances are it's because they're doing something called bank balance accounting. So what I mean by that is that they're probably logging into their bank every day or possibly several times a day or whenever it is that they log into their bank, and they're making decisions based on what's in there. So if for example, there's a lot of money in there, then they're going out and buying things. And if there's not enough money in there, then they're panicking. But if, for example, on a particular day, there's a lot of money, they make a purchase, let's say they go out and buy a van or something along those lines, a big purchase. And then only either at the end of the month or, the month after, they realize they've got a tax bill or something breaks and they weren't expecting to. So they're constantly, sort of up and down in their cash flow. It's very sort of lumpy. It's probably a better way of describing it. So that's the pattern. That's what we see, is the businesses that tend to find themselves in trouble are the ones that are doing bank balance accounting, but then they're not doing it properly. And like the book talks about, it is possible to do bank balance accounting as long as you've got the correct bank accounts. Each bank account has a purpose, and you get into a nice rhythm and habit of how you move money into those bank accounts. And then it'll work perfectly. But a lot of businesses obviously don't do it that way. And that's how they find themselves in a bit of trouble. And then I think the other question you had there was about the sort of the book. So the book, I spoke with a chap called Ron. He works very closely with Mike, has done for years. And we were talking the other day, and I think the book has now sold over 1 million copies. I'm not sure of the downloads, but the book itself is over 1 million copies. I think it's translated now into something like 28 different languages, and there's a few different variations, like you just said there about the Profit First for Contractors and things like that. There's a few different variations out there. They all essentially work around this thing called bank balance accounting.
One thing that I realised many years ago, and actually is a fact as well, that companies generally don't go bust through not making a profit. They go bust because they run out of cash. If you don't control that cash, if you don't actually understand it, then you've got a problem. And I think Profit First is a great system. Add to that a really good cash flow forecast system, and you can start kind of looking forward and see if you've got any problems coming up, and then you've got a chance to do something about them.
Exactly right. That's exactly what it does. So, and you're right. I think anyone can do any sort of Google search they like about what reasons why businesses tend to fail and stuff like that. And it's not usually because they're not profitable, or it was a bad idea, or that the owners weren't very good, or whatever it is. Actually, most of the time, in fact, most of those searches will probably tell you that most of the time it's cash flow. They run out of cash. And a lot of people don't understand the difference between cash flow and the accounts that the accountants are, preparing and submitting to HMRC. There is a difference, I promise.
Absolutely. I mean, one of the comments I get a lot from people that I work with is, my accountant said I made a profit, but I don't actually know where that is. So I've got to pay tax on my profit, but I haven't seen it. Where's the money gone? And I think that's quite common.
That happens all the time for us, several times a week probably, where we're preparing the end of year accounts for somebody, and they're seeing these overall figures for the entire year, of all the money that's come in, and obviously we're detailing where it's all gone out, but they just can't believe where it's all gone. And then obviously at the end it says that there's a profit figure, and for most of them, the most obvious thing is, well, if I've made that profit, if that's what I'm paying tax on, where is it? Why isn't it in the bank account? So then obviously there's another conversation about how and where that's already gone, or potentially still owed. It is a difficult one. But the good thing about the Profit First system is one of those bank accounts is labelled profit. And the idea is that you move a set percentage of whatever comes into that profit account. And then every quarter, you divide that profit in half usually. And half of that money gets retained by the business in a profit hold account. That's sort of building up your war chest. That's for the next opportunity, whatever the business needs to do. And the other half, that's the reward for the owners. So it works really, really well, and it motivates. And the owners, they then know they've got a certain amount of profit that's built up each quarter. Half of it stays with the business, and then the other half is their reward.
Absolutely, and of course, if you're taking your profit out from each invoice, if you haven't got enough money left then to run the company, straight away red flag, early warning sign, there is a problem here. And of course, you can move money back from the profit account to sort it out in the short term, but in the long term, you've got a problem you need to resolve, and it's obvious.
We've got a couple of clients that have sort of said things like, it's like a brilliant measuring stick, for how their business is performing. They haven't got to wait for the end of year accounts or quarterly management or whatever it might be. It's very instant. It's very visual. You'll get into a rhythm and a pattern, and you'll know roughly how much money needs to be in each bank account. And, if you're not able to move that money, or if it's not there, it's very instant and very visual. So yeah, it's very, very clever. Another client said it's kind of like because they've likened in this particular example, the client likened cash flow to or bad cash flow as like a cancer on a business, which I thought was a brilliant way of looking at it. And he said that what we were doing, we were like the doctors with this medicine being profit first, and it was detailing exactly where their cancer was, and what to do about it. So it was a very clever way of looking at it.
Yeah, I think it highlights things very quickly, doesn't it? And I like it as a system. It's simple. I think a simple system will work.
Absolutely. I think in that Profit First for Contractors book, he says somewhere in there along the lines that it's hard enough running a construction company, or any company, to be honest. You don't need extra complicated things to have to worry about. This one, if anything, gives you some time back and simplifies it.
Absolutely. So the Profit First for Contractors was actually written by a guy called Shawn and Dyke. So I did ask him to come and speak to my client once, but his fees were so high, I almost fell over backwards just for a Zoom call. I suppose he's my competition bit in the States. The book's good. I can't take that away from it. I mean, it's obviously just a copy of the main book adapted, and I think the adaptations are right and correct. And I did mention to him, try and negotiate on his fee, that, his uptake in sales of the book in the UK was all down to me, but he didn't take a lot of, didn't seem to change the price. But yeah, it's, I think it's a good system. I think people that put it in place really do benefit from it. Kind of thinking about the kind of companies you work with, what kind of failures have you seen and what kind of near misses have you seen?
So obviously we've been doing this a while now. So yeah, we have seen, unfortunately, some businesses that have failed. We've seen some businesses that have been very close to failing. So yeah, so we've got that experience, I guess, under our belt. I think, like I said earlier, there is a common theme that, regardless of the sector or the type of business or whatever else, is in the main, the ones, the ones that find themselves in that difficulty are the ones that, maybe been too, not necessarily even that they've ignored their accounts, is maybe been too busy to focus their attention on the accounts, or they are making those decisions, like I said, on bank balance accounting, making bad decisions because, like any bank account, sometimes, it's looking good. It's got some money in there, and other times it's not. Panic can sometimes set in and they don't spend money where they perhaps should be spending money, which gets them into more trouble, or they're taking on debt that they maybe can't afford. The book talks about this brilliantly, and I think the contractor one, where it was about a van. So most tradespeople generally have a van, and if they're growing, sometimes they need more than one van, or if that van's coming to the end of its life, either way, they know that there's, unless, say, for example, they're going to take out a finance agreement. Clever thing that the book suggests is that you put a certain amount of money, whatever you think that van payment might be per month, you start putting it into each bank has a purpose, so call it van, whatever you want to, and start putting a set amount rather than just a percentage into that. And then you can see how the business performs. You could do that for a few months, and if your business is struggling, then you're not ready or can't afford that van payment right now. And hopefully on the plus side, though, if everything still continues working fine and it looks like you can afford that monthly payment, brilliant. And then that amount of money is still there, it's still yours, still the business. So when it comes to buying the van, you could use that as a deposit, or if you're part exchanging, then at least you've got that money and you can use it for sign writing or fitting out, whatever you might need. Some vans need some extra stuff. So yeah, it's a really clever way of essentially saving, but saving with a purpose, and at the same time using it as cash flow, your measuring stick, if the business is ready to take on that sort of monthly payment.
I think, that's a really good point. And I love the van scenario. It's something that a lot of my clients get wrong, even the bigger companies. And I was working with a company with about a £4 million turnover, not huge in our industry, but bigger company that I've worked with. And they were making the mistake actually around a van, was all the guys had vans, but they popped the vans in the overhead and they weren't part of the cost on site. So it was really, really diluting their profit. And actually what it was doing was, where they thought they're making 30% per an hour per a person on site, they were making 3%.
100% see that a lot. Yeah. So a lot of people, they think when they get a £10,000 payment, that's 10,000 into the business. It's really not. Out of that 10,000, a chunk of it is going on your overheads, a chunk of it is going out on taxes, and then hopefully a chunk of it is obviously profit. But they've got to start looking at it as that 10,000 or 1,000, whatever it happens to be, is not all theirs. Obviously, it needs to be separated out, and that's what the system does.
Yeah, and it does it very well. It makes you think about this kind of this cost. Anything going into overheads really has to be thought out. But a site cost is different, because a site cost, and your van is a site cost. You can then get profit and overheads on top of that. So it's a double whammy. Rather than it coming out of profit and just disappearing, you're actually making profit on that cost. People get a bit worried about, lots of my clients ask this kind of thing, well, what's your hourly rate? Well, because Fred down the road, he charges 30 quid an hour, so I'm going to charge, I charge 30 as well. We haven't calculated it.
It is tricky for the tradespeople, because they often people want to know how much it is by the hour, by the day, or whatever else, but they sort of forget it's not just that time where they actually see that builder or plumber or electrician on site. It's all the training, it's all the updates and the qualifications they've had to maintain to get to know what they're doing, to be able to hang a door or whatever. Then, of course, it's all their tools. There's wear and tear on those tools. Their customer might not really want to have to pay for a new drill if it breaks on site or whatever else, but they must all hopefully realize anyway, that that drill is wearing itself out. So all those things, right down to the van. Obviously that van has a lifespan on it as well. So all those things. So that's why it's tricky when it comes to an hourly rate. You're not just really trying to charge for that hour of time that somebody's there. It's all the other things that need to be factored in.
Absolutely, and then you've got your profit overheads on top of that. But that's the actual cost of you to the company, or the cost of that person to the company. So however you spin it, if you decide to copy the bloke down the road and charge 30 quid, and the cost to you, of that person is £35, you're actually giving that client 5 quid every hour.
Yeah, you're in trouble. Yeah, it's actually costing you money to do that job. But yeah, there's a lot of businesses, not just trades businesses, and lots of businesses that don't really know or understand their actual costs. Whether they want to boil it down to per hour, per person, or per widget, whatever it is. But obviously that essential. And I might be going off tangent a little bit here, but what we do as obviously Profit First professionals is we do something called a profit assessment. So it's one thing to sort of educate yourself and understand what Profit First is as a cash flow management system and that it used bank accounts. The next logical thing is to have a profit assessment. And that's where we'll work those things out. We'll work out those costs, what they call it real revenue and things like that, and what those percentages should be so that you can get yourself into a rhythm of, right, I've received £10,000. And it's, been 2 weeks or a month or every week, depending on how often they want to move the money. But the idea is to get in a pattern and then move that set percentage into whatever the bank account needs to be and operate the business that way.
And it's a much safer business that way. And, I think it makes you look professional if you kind of understand your business and understand your costs. And if you're standing in front of a client and, you're saying, well, it's £40 an hour and it's a made-up figure, in yourself, as a professional, it's difficult to justify. If you understand where that figure's come from and you understand the cost to you, you kind of much more take it or leave it because that's your cost. So you can be much stronger in, your defence of your costs because of that.
Absolutely. And when somebody asks for 10% off or they try and haggle the price or whatever else, actually, they're looking at the whole price. They're not looking at your profit or whatever your margin might have been. So if you give away a certain percentage of whatever the total value is, again, you've almost shot yourself in the foot.
Totally. And I see that time and time again. And for really small companies, if you're kind of, out there yourself working, that's all you are. Just, you're the company and you're out there. You just split all your overheads, everything, work out an hourly cost, and that's the cost per hour, and that's what you need to cover your costs. And then you put your profit on top of that, because at the end of the day, you might be thinking, well, I want a salary out of this. But if you're running a company, you're entitled to a profit as well. Otherwise, go and work for someone else.
I think you've got to believe, or anyone to go down this route with this cash flow system, you've got to believe that profit is the lifeblood of your business. If you don't make that profit, you're not going to be able to afford to reinvest, buy that next bit of tools or equipment or take on that next opportunity. So if you believe that profit is the lifeblood, then obviously it is really, really essential. You've got to know your numbers.
So I know you can't talk about individual clients because that's just not professional, but I just wonder if you've got examples, and in 17 years there might be one or two, where people have perhaps got it completely wrong, failed, then started again, put in things they've learned into place, and actually had a huge success.
I have the perfect example, yes. So I've got to be very careful, obviously, of how I say this. But yes, essentially, we've got two tradespeople. They were operating their own businesses separately, and they'd been doing it for, I don't know how long, but in this example, just say a few years. And in that time, they'd managed to, do well enough that they'd grown a bit of a brand and reputation. They had a couple of, people working for them. But I think, and this is probably what a lot of people might be able to relate to, is that they felt like they were always busy. They were working very hard. They were, paying the bills, but never felt like they really, making that profit? Where was the, they were able to cover their bills. Do you know what I mean? But there was no, for the amount of extra time, they're the ones going out and doing the pricing and the quoting, and they're going through the stresses. And when someone leaves, and so where was the reward there? And
so they're earning a wage.
Yeah, earning a wage, but it was almost like beginning to resent their businesses. So yeah, I think that's probably fair to say. Then they were obviously working on their own work, and obviously they knew each other anyway, and they started working together. And then I think it made sense to them to sort of join forces. So when they joined forces, they realized that if they just carried on doing everything the way that they've both been doing, chances are it'll be very similar, if not the same, just with bigger numbers and probably more stress. So we obviously did we've got a presentation. So some people, if you don't want to read the book, it makes sense to perhaps have a conversation or presentation. So we did that. They loved the idea and got it straight away. So we did that, and then they, what's next? So we're like, right, well, we need to do the profit assessment. So we were basically combining the figures from their businesses, because although it was a new business when they joined together, it wasn't like a brand new business. It was a business that was starting, with already a few assets, a few vans, a few members of the team, and things like that. So we had to pull the information together, and we did the profit assessment. And what that does is it also gives us something called what we call in fact, I'll go back a step. So when we do the profit assessment, it comes up with something called your current allocation percentages, so CAPs. So what we did there is we worked out if they did nothing different, but they had this system in place, even though they didn't, this is the sort of percentages that they were already paying out. So they already received 100% of their money, and they already paid, roughly 10%, to the owners as their wages. They already paid, 10, 20%, what it might have been on taxes and things like that. And the rest of it was going on overheads. So that's the first part of the profit assessment. We work out their current percentages. Then we work out what their target percentages are going to be. So they're called TAPs. And what that does is it pulls the information that the profit first people have already done. And what they've done is they found fiscally healthy companies that are similar sort of turnover brackets. And they've worked out what they believe, are really good targets to aim for. So we've done this profit assessment with them. We've got their current percentages, and then we've got these target percentages. And then we do something called a rollout plan. So the idea is that we know where they are at the moment in their percentages, and we know where we want them to be. So we do it in baby steps. And what we don't want to do is, let's say, for example, they've never saved anything for profit. We don't, and we know that the target for them might be 10% profit. We don't want to immediately go, right, it might make sense, some people think great, but if you immediately started putting 10% aside in a profit account and you weren't used to doing that, you're going to find it very painful, perhaps, doing the other things that might need to happen with the rest of the money. So we do it in baby steps. And the most obvious one is you perhaps put 1% in that profit account. And this is the sort of stuff we did with them. And it's been over a year now with them. And it was a really nice meeting at that year, because they'd outgrown their the bracket, so they needed another profit assessment. And also they had paid themselves, and they knew where that profit had gone, and they had retained, like I said, 50% of the profit as well. So it was very clear that they had this money set aside, more money than they'd ever had before, set aside for the next opportunity. And they knew how much that they'd paid themselves as they were going along, which again was more than they had ever paid themselves before. So I know it works. It's really, really good.
That's good, and a trades company as well. So that's got to be positive. So just to kind of bring this to a conclusion now, and it's been really interesting. I love the profit system, by the way, and I love talking about it. But as an accountant who's seen so many more companies than most people, if you're going to give kind of 3 pointers, 3 bits of advice to a company setting up that would avoid going bust or avoid failure of any time, what would they be? What would be your 3 kind of main points you'd make?
Okay, I think the first one is a good question, by the way. I wasn't expecting this. So the first one would be to sort of educate yourself. And I don't mean you don't have to become a chartered accountant. I mean educate yourself in that you're probably not the first business that's set up, maybe even in that industry or sector or whatever else, there's going to have been people that have done it before. So talk to them. Most people are quite happy to talk. So almost like either whether it's a coach or a mentor or just someone that you respect or whatever else, but educate yourself. There's obviously books and what we've been talking about here, the Profit First book, or go on a presentation, a seminar, but educate yourself. And in particular, obviously, educate yourself on finance, on your numbers. So that's the first one. Yeah. So I'm not saying educate yourself in that you need to be a chartered accountant, but I mean educate yourself so you're at least aware of knowing your numbers, what goes into them and things like that. That's the first one. The second one, we've been talking about this already. So it's just to implement the Profit First system. So open up those bank accounts. So whether you're a brand new company or you've only just heard about this, is open up those bank accounts. It just makes so much sense that you have a bank account with a purpose, and you get into that habit and that routine. The sooner you get into it, the better. And then the third one, I think, is to just follow through. I think you get so many ideas thrown at you every day. I don't know if you're watching YouTube or TikTok or, you hear it down the pub or whatever else, you hear an idea, that's brilliant, but you never get around to doing it. So I think that the third one is just do it.
Okay, no, that's all very good advice, really. I mean, I think, on the third point, I'd say, following through and what I call consistency. If you have a system like Profit First, it doesn't run itself. So you've got to be consistent in running them. And so companies I see put systems in place and they go, it didn't work. Well, did you run it? Well, no. The lads didn't like it, or so-and-so wouldn't run it, or so. That's kind of, consistency is really important. But three very valid points, I think. So thank you for that. Well, it's been great speaking to you. And, I'm sure we'll meet up again and have further chats. So thank you very much.
Thank you.
Thanks for listening to Bust and Beyond with Robin Hayhurst. Be sure to tune in next time and visit his website at robinhayhurst.com.